Welcome to Iron Financial, the only place where we help you forge a stronger portfolio by cutting right through the market's weakness. I'm your lead analyst. Today, we're grabbing our hard hats and safety vests because we are heading to a job site. We're inspecting the complete reconstruction of a company that has, to put it mildly, through the ringer. Algonquin Power, ticker AQN. Now listen, this isn't just another stock story, this is a full-blown construction project. After a collapse so brutal it nearly leveled the entire structure, the new management team is trying to rebuild from the bedrock up. They claim they're laying a new, unbreakable foundation. Our job, as always, is to be the toughest inspectors on the crew. We're going to stress test the materials, check every load-bearing wall, and we will determine if they are building a financial fortress designed to withstand any economic hurricane, or if this is just a pretty facade that's going to crumble the first time the wind blows. Time to get to work.
And this, right here, is the absolute heart of the matter. You have to understand, this company was basically left for dead. The stock didn't just fall, it cratered. The dividend, the very reason most people own this thing in the first place, it got slashed. And the big money, the institutional funds, they ran for the exits like the building was on fire. But now, you pull up their latest quarterly report, and on the surface, the numbers look incredible. I mean, just jaw-droppingly good, a complete 180. So the question we have to answer today is simple, but it is absolutely critical for your portfolio. Are we watching a genuine, rock-solid turnaround that's creating a durable, long-term investment opportunity? Or is the market just getting sold a fancy blueprint for a company that's destined for low growth, predictable mediocrity? I've got my take, and it's backed by the numbers. But to make sure we stress test every single angle, our market skeptic is here to keep us honest.
You bet I am. Any contractor can show you a glossy 3D rendering and promise you the world. I want to see the structural engineering report. I want to check the permits. Before we buy into any turnaround story, we need to inspect the blueprints ourselves and check the quality of the materials they're using. So here's the game plan for our inspection today. First up, we're going to examine the cracks in the foundation. That means taking a hard look back at what went so horribly wrong that they had to tear the whole thing down. Then, we'll get into the turnaround by the numbers, putting that blockbuster Q1 report under the microscope. After that, we'll analyze the blueprint for the rebuild. That's management's official plan. From there, we're inspecting the core structure, what's actually left of his company, and is it strong enough to build on? And finally, the part you're all waiting for, we deliver the verdict. Is AQN building a fortress, or is it all just a facade? Let's start by digging into the rubble.
Okay, let's get into it. To understand the rebuild, you first have to understand the demolition. AQN was hit by a perfect storm, and frankly, they steered the ship right into the middle of it. For years, the company's entire philosophy was growth at any cost, and it was all fueled by cheap, easy-to-get debt. They were expanding like crazy, especially in the renewable energy business, and they were trying to be two completely different things at once: a sleepy, stable utility and a high-growth, sexy green energy powerhouse. But then the whole world changed. The Federal Reserve started hiking interest rates at a pace we haven't seen in decades, and their entire business model just shattered. It was a house of cards. That massive mountain of debt they'd built up became crushingly expensive. Projects that looked like genius ideas when interest rates were near zero suddenly looked like financial anchors at 5 or 6%. The balance sheet was fragile, overextended, and the market punished them for it. Absolutely punished them. The stock cratered, they were forced to slash the dividend by 40%, and investor confidence was completely obliterated. This wasn't just a small stumble. The very foundation of the company was cracking apart, forcing a change that was as radical as it was necessary. They had no choice. They had to tear it all down and start over from scratch.
Right, enough about the past. The demolition phase is done. At Iron Financial, we focus on the here and now, and the here and now is all about the data. That painful, radical change led us right here to the numbers that have the market absolutely buzzing. So let's fire up the power tools and deconstruct these Q1 2025 results, because this report is the entire basis for the turnaround story. A lot of CEOs can talk a good game, they can spin a great narrative, but the numbers don't lie. So, are we looking at real structural strength here, or is this just a fresh coat of paint slapped over a crumbling wall? Let's drill down and find out.
Okay, now, look at this table. What's truly incredible here is the sheer velocity of this change. Let's start at the top line. Revenue, up 7%. That's solid, respectable growth for utility. Well, look at the next line, net revenue. That's up 10%. Now, this is important. It tells you that their core operations aren't just bringing in more money, they're becoming more profitable. It shows better cost control, better efficiency, but that's not the headline. The real story, the one causing all the fuss, is on that bottom line. Net earnings to common shareholders. This is the number that really moves stocks. In the first quarter of 2024, they were bleeding out, posting a staggering loss of over $91 million. Fast forward just 1 year, Q1 2025, and they post a profit of over $94 million. This is the kind of explosive, whiplash-inducing turnaround that forces Wall Street to pay attention. It is the first powerful piece of evidence that the heavy lifting they've been doing is finally starting to pay off, right where it counts, on the income statement.
And this number, this is the Roman candle that lights up the night sky, plus 203%. This is the figure that flashes across trading screens and triggers algorithmic buying programs. This is the number that makes analysts in corner offices have to sit up, scrap their old models, and start reevaluating everything they thought they knew about this company. From a purely mathematical standpoint, of course, going from a big negative number to a big positive number is going to create an astronomical percentage gain. We get that. But it's more than just math. This is the bedrock of the entire bull case. It's the flag they can plant in the ground that screams turnaround. It tells the market that the bleeding has not only stopped, but the patient is actually healthy and getting stronger by the day. This one number is designed to tell the world that the old, broken, debt-ridden AQN is gone, and a new, lean, profitable machine is being built in its place.
Well, hold on a second. Pump the brakes. A percentage like that can be incredibly misleading. It's flashy, I get it, it grabs headlines, but it doesn't tell the real story. I'd rather look at the hard dollars. We're talking about a positive swing of almost $186 million in a single quarter. That is a massive reversal. So my question is pretty simple. How much of that is real, sustainable, repeatable operational improvement, and how much is just a one-time sugar high from selling off assets and playing games with the balance sheet? Are we seeing the start of a fundamentally healthier business that can do this again next quarter and the quarter after that? Or are we just seeing the cash from selling the family jewels finally hit the bank account? A swing this dramatic, this fast, it makes me deeply skeptical. It feels too good to be true, and in this market, when something feels too good to be true, you better double-check the engineering. We have to know exactly where that money came from before we declare this foundation sound.
That's a completely fair challenge, and it's exactly the right question to be asking. It leads us directly to the next phase of our inspection, the blueprint, because that $186 million swing didn't happen by magic. It wasn't an accident. It was the direct, calculated result of a very deliberate, and I'm sure very painful, strategic plan that management has branded their back-to-basics strategy. This is their official roadmap for rebuilding the company, for pouring fresh concrete into those cracked foundations, and creating the kind of sustainable, predictable earnings you're asking about. So let's unroll the actual plans and see what kind of structure they're trying to build here.
And here you have it, straight from the man in charge, CEO Rod West. The mission statement is as clear as it gets. Build a premier, pure-play utility. Now let's break down that corporate speak, because every single word there was chosen carefully. Premier, not biggest. That signals a focus on quality, on profitability, on efficiency, not just getting bigger for the sake of getting bigger. But the most important phrase is pure play. This is a direct message to the market. They are explicitly stating that the old AQN, the one that tried to be a jack of all trades, a high-growth renewable developer, and a stable utility, is dead. That model failed them. The new AQN has a singular focus. This isn't about chasing growth at all costs anymore. It's about stability, predictability, and focus. This quote is the North Star for every single decision they're making.
So how do you actually execute that vision? How do you go from a quote to reality? It boils down to these three massive critical steps. This is the core of the entire reconstruction. Step 1, major surgery. They made the brutal decision to sell off the entire renewable energy business. This was once the crown jewel, the engine of their growth story. But in a world of high interest rates, it became an anchor of volatility and a black hole for capital. Step 2, take the cash from that sale and fix the biggest crack in the foundation, the toxic balance sheet. They retired approximately $1.6 billion in debt. This move immediately reduces their interest expense and de-risks the entire company. And step 3, with the volatile assets gone and the balance sheet patched up, they can finally focus all their energy, all their capital, and all of their management's attention on what's left, the boring, predictable, but incredibly stable, pure-play regulated utility business.
And let's not just gloss over this number, $1.6 billion. In today's market, debt is poison. It's a boat anchor. By cutting this much debt loose, AQN has given itself an incredible amount of breathing room. It strengthens the balance sheet, it improves their credit ratings, which makes any future borrowing cheaper, and most importantly, it lowers their ongoing interest payments. That cash flows directly to the bottom line and boosts earnings per share. This isn't just shuffling numbers around on a page, it's a fundamental strategic decision to build a more durable, more resilient financial structure that can actually withstand economic headwinds. If the balance sheet is the foundation of the house, then this debt paydown is the high-strength steel rebar they're pouring into the new concrete.
Okay,
The steel rebar is great. I love a strong foundation. But this slide right here tells the whole story, doesn't it? On the left, you've got the solar panels, the wind turbines, what many people would call the future of energy. This was the high-growth story, the narrative that got growth investors excited in the first place. And that's what they sold off. On the right, you've got the transmission lines, the old-school utility infrastructure. Stable, reliable, but let's be honest, it's boring. And that's what they kept. So the fundamental question I have is this. Did they just sell their future to pay for the mistakes of their past? Yeah, they fixed the balance sheet, I get that. But at what cost? Have they essentially performed a corporate lobotomy, removing the one part of the company that had the most potential for dynamic long-term growth?
And that right there is the billion-dollar question every investor has to ask themselves right now. Is this back to basics plan a brilliant, disciplined strategy to create a stable, dividend-paying fortress for tough economic times, or is it an admission of defeat, a sacrifice of all future high-growth potential just to achieve a predictable and ultimately uninspiring level of mediocrity? One person looks at this and sees a fortress, designed for safety and security above all else. I look at it and I see a bungalow. It might be safe, it's probably well built, but you're not going to get a great view from the first floor, and the resale value isn't going to skyrocket. The answer to this question is what will ultimately determine whether AQN is a value trap or a genuine long-term opportunity.
And to answer that billion-dollar question, we have to get our hands dirty. A building is only as good as its core structure. So let's move on. Let's put on our inspector hats and go deep. We are going into the one division that's left holding up the entire company, the Regulated Services Group. The entire bull case, the whole story from here on out, rests on the performance and the strength of this one single division. This is the foundation, the load-bearing walls, the entire support system. So is it strong enough? Is it growing? Is it even well-run? Let's find out if these walls are made of reinforced concrete or cheap cardboard. The data has to give us the answer.
And here we go. Here is the first piece of hard evidence. This chart is Exhibit A for the bull case. The core business they decided to keep isn't just sitting there, it's growing. And it's growing nicely. What you're looking at are the full-year net earnings for just the Regulated Services Group. In 2024, it cranked out about $260 million in profit. In 2025, that jumps to $351 million. You're talking about a nearly 35% increase in profitability from the very part of the business they decided to build around. So here's the crucial takeaway. This directly counters the argument that they've been left with a stagnant, no-growth asset. This isn't a story about a utility just treading water. The core itself is getting stronger and more profitable. The foundation isn't just solid, it's actually expanding.
And it's not just about making more money. They are getting better and better at actually running the business. This is so critical. The back-to-basics strategy isn't just about selling assets. It's about operational excellence. Look at these highlights from 2025. They cut their operating expenses as a percentage of revenue. That is pure efficiency. That's doing more with less. They improved their earned return on equity, or ROE, from 5.5% to 6.8%. That is a key metric for a utility's profitability, and it is moving decisively in the right direction. They are getting constructive regulatory outcomes, which is just Wall Street jargon for saying they're successfully getting approval for rate hikes, which is how a regulated utility makes more money. And they've put together a new executive team with deep experience in exactly this kind of business. This is the proof that they are sweating the details and doing the hard, unglamorous work of optimization.
Okay, fine, I'll concede the point. Operationally, they look solid. I've gone through the numbers myself. The core business is stable, it's profitable, and the new management team absolutely knows what they're doing. I don't think the building is going to collapse. But that brings us right back to the central problem, doesn't it? Look at this picture. It's a utility worker doing his job. It's essential. It's reliable. It's a fantastic service for society. But is it an exciting investment? Is a business that looks like this going to deliver the kind of capital appreciation that shareholders are really looking for? Or have you just bought a glorified bond that might spit out a small dividend and give you single-digit growth at best? The fortress might be secure, I'll give you that, but is there anything valuable inside worth protecting? It might be a great company, but does that make it a great stock?
And that right there is the final piece of the puzzle. It is the crucial difference between a good business and a good investment. We've seen the damage from the past. We've analyzed the impressive turnaround numbers. We've inspected the blueprint of their new strategy, and we've stress-tested the core structure they're building on. Now, it's time to put it all together. It's time to render a verdict. Is Algonquin Power building a fortress for your portfolio, or is this impressive turnaround just a convincing facade that's hiding a low-growth, uninspiring reality? Let's look at what the company and Wall Street expect for the future.
Here it is. This is the company's official guidance for the next 2 years. You can think of this as their contract with Wall Street. They're projecting adjusted net earnings per share in a range of 35 to 37 cents for 2026. For 2027, they see that growing to a range between 38
and 42 cents. So let's just take the midpoint of those ranges. Going from 36 cents in 2026 to 40 cents in 2027, you're looking at roughly 11% year-over-year growth in earnings per share. Now, it's not the explosive, headline-grabbing growth they once promised with the renewables business, but it's steady, it's predictable, and it's built on that regulated utility base. This is the blueprint translated into dollars and cents.
And here is the engine that is supposed to drive that 11% growth. They aren't just sitting back. They are planning to invest a massive $3.2 billion in capital expenditures over the next 3 years. Now, for a regulated utility, this is everything. CapEx is the direct driver of earnings. It works like this. They invest billions to upgrade the power grid, and in exchange, regulators allow them to earn a guaranteed return on that new investment. That investment is called the rate base. So this multi-billion-dollar spending plan is designed specifically to grow that rate base by 5 to 6% every single year. That is the fundamental mechanical process for creating value in a utility. More investment equals a bigger rate base, which equals higher, more predictable earnings. It's really that simple.
And look, if you think this is just me and him arguing for the camera, you are dead wrong. Wall Street itself is completely divided on AQN, which proves this is a legitimate battle of investment philosophies. On one side, you have the raging bulls at National Bank. They see the plan, they see the CapEx spending, and they are all in. They've upgraded the stock to outperform and slapped a $7.50 price target on it. They're forecasting absolutely massive EPS growth of over 20% in 2027. But on the other side of the street, you have the more cautious bears at Raymond James. They're sticking with their market perform rating, which is basically Wall Street code for a neutral hold. They see the exact same plan, they see the exact same numbers, but they remain unconvinced that it's going to translate into outsized stock performance. The pros can't even agree on this, which means you better do your own homework.
So let's bring it home and summarize the bull case. The bulls look at AQN and they see a fortress. They see a company that walked through fire, made the tough but absolutely necessary decisions, and has emerged on the other side stronger, leaner, and more focused. It is now a streamlined, financially disciplined machine. The balance sheet has been repaired, the earnings are predictable, and there's a clear, funded plan for reliable, single to low double-digit growth for years to come. For an investor who is sick and tired of market volatility and is looking for safety, stability, and a reliable dividend, this looks like an incredibly solid structure to add to a portfolio.
But here's what I see. I see a facade. The impressive turnaround numbers were a one-time sugar high from an asset sale. What's left is a company that intentionally cut out its own growth engine. They've turned themselves into a slow-growing, low-return utility that's going to have to fight tooth and nail with regulators for every single penny of growth. The bears, and I'm standing with them on this, believe this new, safe company simply lacks the dynamism to deliver the kind of returns that create real long-term wealth. The house is stable, sure, but it's a small, boring bungalow in a neighborhood where property values never go up. It won't fall down, but it's never going to make you rich either. So at the end of the day, it all comes down to this one question. Nobody can deny that AQN has successfully rebuilt its foundation. The balance sheet is stronger, the business is focused, the bleeding has stopped, the heavy lifting is done. The crucial question for you and for your portfolio is, what are they going to build on top of that new foundation? Will they use this newfound stability as a platform to build a skyscraper, a premier utility that consistently delivers value and market-beating growth year after year, or have they simply built a very solid foundation for a bungalow? Safe, secure, but ultimately a small and uninspiring investment designed for capital preservation, not capital appreciation. Your answer to that question depends entirely on your goals as an investor. That's our analysis. This is Iron Financial. Do your own due diligence. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.